$100 trillion. That is roughly how much the world owes. Not one country, not one government. The entire global system, governments, corporations, and households all borrowing from the future at a scale humanity has never attempted before. For decades, the system worked. Debt was cheap, growth was strong, and the bill could always be pushed further into the future. But that era may be ending. Interest rates are rising, economies are slowing, and across the world, a question is quietly emerging among economists and policymakers. What happens when the world can no longer afford its own debt? This is the story of the global debt crisis and how the modern economy may be approaching one of its most dangerous financial turning points. Why global debt is the defining risk of our era. For much of the 20th century, debt was understood as a tool, a mechanism through which governments could invest in infrastructure, fund wars, or stabilize economies during periods of crisis. Used wisely, borrowing could accelerate growth. The returns on investment would, in theory, exceed the cost of the debt itself. But something fundamental has shifted. In the past 2 decades, the scale and speed of debt accumulation across the world has moved far beyond what traditional economic frameworks anticipated. Governments that once borrowed strategically are now borrowing structurally, not to invest in the future, but simply to meet the costs of the present. According to the International Monetary Fund, global debt, public and private combined, reached approximately 235% of world GDP in recent years. For context, total global economic output is roughly $100 trillion annually. The debt sitting on top of that economy is more than twice as large. What makes this moment particularly consequential is the intersection of 3 forces: the sheer magnitude of accumulated borrowing, the rapid rise in global interest rates, and the uneven distribution of debt stress across both rich and developing nations. Together, these forces have created a set of vulnerabilities that the global financial system has not faced in living memory. To understand how the world arrived here and where it may be heading, we need to trace the arc of debt accumulation back to its origins, how the debt built up from 2008 to today. The story of modern global debt begins in September 2008, when the collapse of Lehman Brothers sent shockwaves through the world's financial system. Within weeks, credit markets froze, stock markets crashed, and governments around the world faced a choice: allow their economies to contract violently, or intervene with unprecedented force. They chose to intervene. Central banks slashed interest rates to near zero. Governments launched massive stimulus packages, bailing out banks, subsidizing industries, and pumping money into public spending. The United States alone committed trillions of dollars in fiscal and monetary support. The Eurozone, the United Kingdom, Japan, China all followed similar paths. These measures stabilized the immediate crisis, but they came at a cost: a dramatic and lasting increase in public debt. Governments had borrowed heavily, and the low interest rate environment that followed made that debt relatively cheap to service. For more than a decade, borrowing was, in economic terms, almost free. That era of cheap money fundamentally altered the behavior of governments, corporations, and households. When borrowing costs are low, the incentive to borrow is high. Why save when debt is nearly costless? Why tax when you can borrow? This logic, applied across decades and across continents, produced the debt mountain that now defines the global economic landscape. Then came the next shock. In 2020, the COVID-19 pandemic triggered the most severe global economic contraction since the Second World War. Governments once again reached for the tools they had used in 2008, but this time, the scale was even larger. The IMF estimates that global governments spent approximately $16 trillion in fiscal support during the pandemic years. In a single 2-year period, the world added more public debt than it had in the previous decade. By the time the pandemic receded, governments that had entered 2020 with already elevated debt levels found themselves carrying obligations that, in many cases, had no historical precedent. The question now was no longer about the wisdom of borrowing. It was about what happened when the bill finally came due. The sovereign debt explosion. America, Europe, China, and the developing world. Nowhere is the debt story more visible or more consequential than in the United States. America's national debt has now surpassed $33 trillion, a figure that exceeds the country's annual GDP. For much of the 20th century, the United States maintained debt levels that, while significant, were broadly manageable relative to the size of the economy. That calculus has changed dramatically. What makes American debt particularly complex is that it sits at the center of the global financial system. U.S. Treasury bonds are the world's benchmark safe asset, the instrument that investors, central banks, and sovereign wealth funds hold when they want security. American debt is not merely a domestic fiscal problem. It is, in a very real sense, the foundation upon which global finance is built. Any sustained loss of confidence in U.S. fiscal management would not merely harm the American economy. It would send tremors through every corner of the global financial system. Across the Atlantic, Europe presents a different but equally challenging picture. The Eurozone's fundamental tension, A monetary union without a fiscal union has never been fully resolved. Countries like Italy and Greece carry debt-to-GDP ratios well above 130%. The European Central Bank has, at various points, effectively backstopped these sovereigns through bond-buying programs. But that support is not unlimited, and the political sustainability of Northern European nations underwriting Southern European debt remains fragile. China's debt story is perhaps the most opaque of all. Official government figures suggest manageable levels of public debt, but when analysts include the obligations of local government, financing vehicles, the off-balance sheet instruments through which China's regional governments fund infrastructure and real estate development, the total rises dramatically. Estimates of China's true public and quasi-public debt burden range from 80 to over 100% of GDP, and crucially, much of this debt is tied to a property sector that has experienced a severe and ongoing correction. For developing economies, the picture is often the most immediately precarious. Countries that borrowed heavily in dollars during the era of low interest rates now find themselves facing a double bind. Their revenues are in local currencies that have depreciated, while their debts are denominated in dollars that have strengthened. The arithmetic of this mismatch is unforgiving. Interest rates and the debt trap for over a decade. The world's debt was built on a single, foundational assumption that interest rates would remain low indefinitely. That assumption turned out to be wrong. Beginning in 2022, central banks across the developed world, led by the United States Federal Reserve, embarked on the most aggressive interest rate tightening cycle in 40 years. The target was inflation, which had surged in the aftermath of the pandemic-era stimulus. By late 2023, U.S. interest rates had risen from near zero to above 5%. European rates followed. The era of free money was over. What happens when the cost of borrowing rises faster than economies can grow? The answer, for heavily indebted governments, is deeply uncomfortable. The interest payments on existing debt increased. New debt must be issued at higher rates, and a growing share of government revenue, money that might otherwise fund healthcare, education, or infrastructure, is redirected towards simply servicing the interest bill. The United States now spends more on interest payments on its national debt than it does on its entire defense budget. That is not a commentary on the adequacy of defense spending. It is a measure of the extraordinary scale of debt service costs that the federal government now carries. The Congressional Budget Office projects that, under current trajectory, interest payments will consume an ever larger share of federal revenue for decades to come. This dynamic, where debt service crowds out productive investment, is sometimes called the debt trap. It is a condition in which a country's debt grows faster than its ability to generate the tax revenues needed to manage it. Once inside the trap, the options are narrow and none of them are painless. Raise taxes, cut spending, inflate away the debt, or restructure it. Each path carries significant economic and political costs. The debt trap is not merely a theoretical risk. For a growing number of countries around the world, it is already a lived reality. The hidden risk: debt crises in the developing world. While the debt challenges of rich countries dominate headlines, some of the most acute suffering is playing out in the developing world in countries that lack the economic buffers, the reserve currencies, and the institutional credibility to manage debt crises with the tools available to wealthier nations. Sri Lanka's collapse in 2022 was one of the starkest illustrations. A combination of excessive external borrowing, foreign exchange shortages, a collapse in tourism revenues, and poor fiscal management left the country unable to pay for basic imports, fuel, medicine, food. The government defaulted on its external debt for the first time in its history. Ordinary citizens faced hours-long queues for petrol, power cuts lasting 16 hours a day, and a political crisis that brought down the government itself. Argentina has lived through this story so many times that it has become a grim archetype of sovereign debt dysfunction. The country has restructured or defaulted on its external debt 9 times in its history. Its most recent crises reflect a chronic inability to generate the fiscal surpluses needed to service its debts, compounded by a currency that markets have repeatedly refused to trust. Pakistan has repeatedly returned to the International Monetary Fund for emergency support, each time implementing austerity measures that impose severe hardship on a population with limited capacity to absorb such shocks. Ghana, Zambia, Ethiopia, and several other sub-Saharan African nations have entered formal debt restructuring processes in recent years, reflecting the breadth of the developing world debt crisis. What these cases have in common is not simply bad policy, though that has often played a role. They reflect a structural vulnerability. Developing economies that borrowed in foreign currencies, at floating interest rates, based on optimistic growth projections, in an era when global financial conditions were uniquely benign. When those conditions changed, the vulnerabilities were exposed with brutal speed. The human cost of these crises is not abstract. It is measured in children who cannot access medicine, in businesses that cannot import raw materials, in a generation whose economic futures are constrained by the debts of governments. They did not elect China's lending strategy, the Belt and Road and the debt diplomacy debate. Discussion of the global debt crisis would be complete without examining the role of China, not merely as a debtor, but as a creditor to a significant portion of the developing world. China's Belt and Road Initiative, launched in 2013, was presented as an infrastructure development program, a modern Silk Road of ports, railways, power plants, and highways connecting Asia, Africa, the Middle East, and beyond. But it was also, fundamentally, a lending program. State-controlled Chinese banks, primarily the China Development Bank and the Export-Import Bank of China, extended hundreds of billions of dollars in loans to developing countries for Belt and Road projects. The terms of these loans varied widely, but critics identified several patterns that they argued were problematic. Interest rates were often higher than those available from Western multilateral lenders. Repayment terms were sometimes structured around specific revenue streams, such as port revenues, which could give Chinese entities significant leverage in the event of default. And the opacity of the loan agreements, many of which were not disclosed publicly, made it difficult for borrowers, civil society, or international creditors to assess the full extent of obligations being undertaken. The concept of debt trap diplomacy emerged from these critiques. The theory that China deliberately extends loans on terms it knows borrowers cannot repay, with the intention of extracting strategic assets or political concessions when borrowers default. The most frequently cited example is the port of Hambantota in Sri Lanka, which was leased to a Chinese state company on a 99-year basis after Sri Lanka struggled to repay its debt. Chinese officials and some independent researchers have disputed the debt trap narrative, arguing that it overstates Chinese strategic intent and that no clear pattern of asset seizure following default can be demonstrated. What is less disputed is that China's lending has contributed to unsustainable debt burdens in a number of countries, and that the restructuring of these loans has proven extraordinarily difficult, partly because China has resisted coordinating debt relief through established multilateral frameworks as developing country debt crises multiply. The question of how China engages with debt restructuring has become one of the most consequential geopolitical dynamics in international finance. The risk to the global financial systems: debt does not exist in isolation. It is held in vast quantities by banks, pension funds, insurance companies, and financial institutions around the world. When the value of government bonds falls, or when a sovereign defaults, the effects ripple outward with potentially systemic consequences. The 2010-2012 European sovereign debt crisis provided a preview of this dynamic, as yields on Greek, Italian, and Spanish government bonds surged in response to fears about fiscal sustainability. The banks that held those bonds, many of them in the same Eurozone countries, faced significant losses. The crisis nearly fractured the Eurozone entirely, requiring extraordinary intervention by the European Central Bank to stabilize. Today, the exposure of global banks to sovereign debt is, if anything, larger than it was in 2012. Regulatory frameworks in many jurisdictions treat government bonds as zero-risk assets, a classification that, while analytically questionable, has encouraged banks to accumulate them in large quantities. If a significant sovereign debt stress event occurred, the balance sheets of major financial institutions could be impaired in ways that current stress testing may not fully capture. Bond markets themselves have become sources of systemic risk. The United Kingdom experienced this in 2022, when the Truss government's unfunded fiscal package triggered a sudden sell-off in UK government bonds, known as gilts, that threatened to collapse the pension fund sector. The Bank of England was forced to intervene in emergency bond purchases within days. It was a vivid illustration of how quickly a loss of market confidence in fiscal credibility can translate into a financial emergency. The US Treasury market, the deepest and most liquid market in the world, has also shown signs of stress at moments of heightened anxiety. Periods of thin liquidity, rapid repricing, and the withdrawal of market makers have raised questions among regulators about the resilience of the infrastructure underpinning global fixed income markets. These episodes are not proof that a crisis is imminent, but they are evidence that the architecture of the global financial system, built on the assumption that sovereign debt is stable and risk-free, is under more pressure than at any point in recent decades. What comes next? 3 possible futures. Assessing the trajectory of the global debt crisis. Analysts broadly identify 3 plausible scenarios. They are not mutually exclusive, and elements of each may manifest simultaneously in different parts of the world. The first scenario is prolonged debt pressure, a slow grinding of constraints rather than a sudden break. In this outcome, heavily indebted governments continue to service their debts but at increasing cost. Austerity measures, higher taxes, and reduced public investment become persistent features of fiscal policy. Growth is subdued, living standards stagnate, political discontent rises as populations experience the consequences of debt service crowding out public services. This is not a crisis in the dramatic sense. There is no single moment of collapse, but it is a sustained deterioration in economic capacity and political stability across a wide range of countries. Many economists believe this is the most likely trajectory for much of the developed world. The second scenario is a cascading financial crisis, a more acute outcome triggered by some combination of shocks. a major sovereign default by a systemically significant economy, a rapid loss of confidence in U.S. Treasury markets, a severe stress event in the Chinese financial system linked to its property and local government debt. Any of these could serve as catalysts. The interconnectedness of the global financial system means that a sufficiently large shock in one node can propagate rapidly to others. Unlike 2008, governments and central banks now have less monetary and fiscal space to deploy in response. Interest rates have already been raised, and public debt is already elevated. The tools available for a next crisis are more limited than those that were available for the last one. The third scenario is a more orderly restructuring of the global financial architecture, a process already visible in nascent form. Countries renegotiate debt with creditors, accepting losses in exchange for sustainability. Multilateral institutions evolve to better coordinate between Western and Chinese lenders. New frameworks for sovereign debt resolution, longer gap in international economic governance are developed. This scenario requires significant cooperation between geopolitical rivals, a difficult but not impossible condition. It is, in many ways, the most constructive path forward, but also the one that requires the greatest political will from the greatest number of actors. What is common to all three scenarios is that the era of painless borrowing is over. The decisions made in the years ahead by governments, by central banks, by international institutions, and by geopolitical powers will shape not merely the economics of debt, but the distribution of power, influence, and stability in the world. Closing analysis: debt, power, and the world order. Debt, at its most fundamental, is a relationship, a claim on future resources, a transfer of obligation across time. When individuals or institutions can no longer honor those obligations, relationships fracture, trust dissolves, and the systems built upon them come under strain. What makes the current moment so geopolitically significant is that the debt crisis is not merely an economic phenomenon, it is reshaping the distribution of power between nations. Countries burdened by unsustainable debt have less capacity to invest in their militaries, their infrastructure, their diplomatic relationships. They are more vulnerable to the influence of creditors, whether those creditors are the International Monetary Fund, Western bond markets, or Chinese state banks. For the United States, the question of fiscal sustainability is inseparable from the question of global leadership. American power has rested, for decades, on the dollar's status as the world's reserve currency, a privilege that itself depends on confidence in American fiscal governance. If that confidence is eroded, the consequences will extend far beyond bond yields. For China, debt is a double-edged instrument. It has used lending as a tool of geopolitical influence, extending its reach across the developing world, but it also carries its own enormous internal debt burden, one that represents perhaps the most significant unresolved risk in the global economy. A severe Chinese financial crisis would reverberate globally in ways that no amount of geopolitical positioning can fully insulate against. For the developing world, the debt crisis is, most immediately, a human story of countries caught between the demands of international creditors and the needs of their own populations, forced to make choices that no democratic government should have to make. The global debt crisis will not be resolved quickly, and it will not be resolved painlessly. It will require a combination of fiscal adjustment, institutional innovation, and geopolitical cooperation that is historically rare. But the alternative, continuing to accumulate obligations that the world economy cannot sustainably support, carries consequences that no responsible actor should be willing to accept. $100 trillion. The world owes it. The world must reckon with it. And how that reckoning unfolds will define the geopolitics of the coming generation. This has been a geopolitical analysis of the global debt crisis. Strategic analysis helps us understand escalation, but understanding conflict does not mean wishing for it. History repeatedly shows that war, in any form, carries costs that extend far beyond military objectives. Economic disruption, political instability, and human suffering rarely remain confined to battlefields. Whatever the strategic calculations, the hope remains the same, that tensions are contained before they harden into open conflict, and that decisions made in the first hours prevent consequences that could last for decades, because in the end, no doctrine, no missile system, and no alliance structure can erase the long-term cost of war.